What's going on, you guys? This is a new series that Daniel actually had an idea for, so let's get into it. So, what's going on, you guys? It's been a minute. My name is Charles Rice. This is the Traders Corner. Traders Corner, you'll find a lot of content around trading, investing, and things of that nature, as that's the things that we're interested in, we've liked to do for a long time now. So that being said, let's get into this video and what this is and, the larger series that we're going to be doing around this video or these types of videos. So the basic idea for this series or these videos is, as a trader who has taught myself to code, I often use coding in products such as Quant Connect, which you see me using here in this video, to quickly backtest trading ideas by coding them and then setting them off to backtest, right? It's something I do basically every day at this point, and Daniel thought, hey, why not share the attempts each day until we find, quote unquote, the holy grail. Now, we're not idiots. We know we won't find a strategy that basically never loses or anything like that. But the goal isn't to find a strategy that never loses, but to find strategies that achieve basically above a 0.65 Sharpe ratio over a 5-year period. Now, most videos you'll see my ideas crashing and burning in terms of trying to achieve this metric. But after about a year of doing this almost every day, I've come to realize when it comes to coding a strategy that has a real Sharpe ratio or any real alpha, you get a lot more failures than successes. It's really hard to do. But if it wasn't hard to do, everyone who could code would be a market millionaire. Now, I've coded a few strategies at this point that have, back tested good Sharpe ratios, and I've started to forward test them. And some of them have worked, some of them haven't really worked too well, right? And some I'm still testing them to see if they continue to work. But at this point, I'm still in this process of trying to find different ideas. Now, at this point, I've coded, like I said, a variety of strategies to try to get this done, from technical analysis, straight up technical analysis, Forex strategies, to more machine learning futures trading strategies and options trading strategies, or just fundamental factor investing algorithms as well. But my current focus is on building more quant-based strategies. Now, these strategies, or quant-based strategies, quote unquote more quant-based strategies, employ generally things kind of as a basic, as basic categories, things such as like statistical or more basic arbitrage, things like pairs trading, which you'll see in this video, quant trend following, which is essentially using, different formulas besides maybe a basic moving average to analyze things like trends in either single securities or correlated securities, or also things like event trading strategies, right? Using, different models to do the probabilities of certain events happening, and then, making a trading decision based on those probabilities and those events. Right now, in this video, you'll see me attempting to code a mix of essentially a pairs trading / mean reverting strategy that attempts to take advantage of short-term intraday divergences between natural gas and crude oil prices. Now, why am I doing this? Well, basically, as technology has evolved for refining and using natural gas, so the products that we use as end consumers are now, more of them are able to use natural gas, right? And the technology for getting natural gas has improved. Natural gas has become more of somewhat of a substitute for crude in some instances, right? And so in moments of calm, what you tend to see is a strong correlation in their prices, which you'll see me calculating using simple pandas and sklearn linear regression models in the Quant Connect research environment, right? And also I employ a few functions that I've coded, through my time coding different stuff for machine learning. I prepared these functions months ago to help me reshape data into usable shapes based upon the model I'm using, right? So, linear regression models like the model you see me using in this video, they tend to like 2-dimension data, while LSTM models, which are models that I like to employ for time series forecasting, for example, tend to like 3-dimensional data, right? If you want to know more about these kind of weird ass words that I just described, here's some helpful video links. I'll link them right here in the video. Now, after calculating these correlations in the Quant Connect research environment, which is basically just their in-house Jupyter notebook, I went to code a strategy that would allow me to backtest the actual idea itself. At first, I tried using futures contracts, but that didn't work too well, and for a reason I'm not really sure of, and I'm still investigating right now. And I tried this yesterday, so I'm still, investigating it today. But I was able to use CFDs and get some backtest working, just to kind of get some general ideas out there in terms of different ways to actually look at the divergence, right? I'm employing different ideas around price divergence, maybe price and EMA divergence, or price and Bollinger Band divergence to ID when that correlation may be broken on a possible intraday level. Now, the Sharpe ratio for 2022 year to date was good, but the 5-year Sharpe ratio left a lot to be desired. I'm going to look to employ different risk management ideas and entry ideas as I did get that good 2022 to year to date Sharpe ratio of 1.29. So there could be some potential in this idea. But again, there needs to be more work on it, whether it be risk management or even just the entry idea itself. But I hope you enjoyed this video. And again, definitely check back tomorrow as I'll show you what I'm trying to do tomorrow, and kind of what I finished out trying to do today as well. So yeah.